Astera Labs has become one of the hottest semiconductor stocks of 2025. The company's share price has surged in recent months, supported by strong financial results, rapid adoption of its products, and its increasingly central role in artificial intelligence. The company's share price has surged in recent months. This is supported by strong financial results, rapid adoption of its products, and its increasingly central role in artificial intelligence infrastructure. In this video, we'll explore why the stock has moved higher, what the business model looks like, and how the company is performing financially, where its growth is headed, the risks involved, and how investors should think about its valuation. Astera Labs was founded in 2017 and is headquartered in Santa Clara, California. The company does not build GPUs or CPUs. Instead, it solves the connectivity problems that arise when these powerful chips need to communicate across a large AI data center. To do this, Astera has built what it calls the Intelligent Connectivity Platform. This integrates high-speed mixed-signal semiconductor products with a proprietary software suite known as Cosmos. Together, these solutions address data transfer, memory, and networking bottlenecks that can slow down AI workloads. Astera's product portfolio is built around four main families, each targeting a different bottleneck inside AI data centers. First is Aries, the PCIe retimers. When data signals travel across long connections inside servers, they degrade, become noisy, and error prone. Astera's Aries retimers act like interpreters or signal boosters. They clean up the signal and retransmit it. This ensures flawless communication between CPUs, GPUs, and other components. As servers move to higher speeds with PCIe 5.0 and PCIe 6.0, retimers become absolutely essential. The second product of the portfolio is Leo, the CXL memory controllers. One of the biggest challenges in AI computing is limited memory. GPUs are powerful, no doubt, but often run out of memory when training massive models. CXL or Compute Express Link is a new industry standard that allows CPUs and GPUs to share and pool memory seamlessly. Astera's Leo controllers are at the forefront of enabling this shift. This makes memory expansion and pooling a reality. Third is Taurus, the smart cable modules. These are active electrical and optical cables that enable high-speed Ethernet connections within AI racks. As AI workloads demand ever faster networking speeds, Taurus modules help deliver low-latency, power-efficient links. Finally, we have Scorpio, the PCIe fabric switches. These switches act as traffic directors, connecting many CPUs, GPUs, and accelerators into one large computing cluster. The new Scorpio P series and X series switches have already gained traction, and in their very first quarter of ramping, they contributed over 10% of Astera's revenue. Together, these four product lines, Aries, Leo, Taurus, and Scorpio, form a complete connectivity suite for AI data centers. This breadth of offering makes Astera unique because it can capture multiple dollars of content in every rack being deployed worldwide. This mix of hardware and software is what makes Astera Labs unique. The company positions itself not as a component supplier but as an enabler of next-generation data centers. Astera is working with hyperscalers like Microsoft, Amazon, and Google to make their AI infrastructure run faster and more efficiently. Several developments explain why Astera Labs stock has appreciated so sharply. The first and most obvious reason is the company's extraordinary revenue growth. In the second quarter of 2025, Astera reported revenue of nearly $192 million. That was a 150% increase compared to the same quarter a year earlier and a 20% rise compared to the previous quarter. The second reason is profitability. Astera reported net income of $51 million for the quarter, reversing a loss in the prior year. Its non-GAAP gross margin stood at 76%, which is exceptionally high for a semiconductor company that is still in the early stages of scaling up. Another important factor is the diversification of revenue sources. In the past, most sales of Astera came from the Aries line of retimers. Today, revenue comes from multiple product families, with Scorpio alone already exceeding 10% of total revenue in its very first quarter of ramp up. That diversification reduces risk and shows that the company is executing across its entire portfolio. The stock has also benefited from ecosystem wins and partnerships. Astera expanded its collaboration with NVIDIA through the NVLink Fusion program. It deepened ties with AMD in support of UA Link Open Standard, and it partnered with AI Chip to serve custom ASIC developers. These relationships provide validation that Astra's technology is essential to next generation AI racks. In addition, the strength of its balance sheet has reassured investors. At the end of second quarter, Astera held more than $1 billion in cash and securities while carrying only about $100 million in current liabilities. That gives company plenty of runway to fund research, expand production capacity, and even pursue acquisitions if needed. Finally, the market is rewarding Astera because it sees the company as a foundational enabler of AI growth. While GPUs get the headlines, hyperscalers like Amazon, Microsoft, and Google know that without robust connectivity, those GPUs cannot be used effectively. Astera sits right in the middle of this build out, which explains the investor enthusiasm. These elements, together with consistent analyst upgrades and a string of earnings beats, have given investors confidence that Astera Labs is not just a niche player but a central platform provider in the AI boom. The financial results for the second quarter of 2025 speak for themselves. Revenue came in at $191.9 million compared with $76.8 million in the second quarter of 2024. For the first half of the year, revenue already reached $351 million, almost equaling the company's entire revenue for the full year 2024. Net income for the quarter was $51.2 million, a dramatic turnaround from a loss of $7.5 million in the prior year quarter. For the first half of 2025, net income totaled $83 million. Gross margin at 75.8% dipped slightly from the previous year due to a greater share of hardware module sales. These usually carry lower margins than pure silicon. However, this was more than offset by operating leverage. Operating margin climbed to 39% on a non-GAAP basis, which reflected disciplined cost control even as the company invested heavily in research and development. Astera also generated healthy cash flows. Operating cash flow reached $145.9 million in the first half of 2025. On the balance sheet, the company reported $1.18 billion in current assets against just $106 million in current liabilities. This shows a highly liquid position for the company. Looking ahead, management has guided for third quarter revenue in the range of $203 to $210 million. This implies further sequential growth of about 6 to 9%. Margins are expected to remain around 75%, underscoring both growth and profitability. Astera Labs operates under a fabless model. It designs its semiconductors internally but outsources the manufacturing to TSMC and uses partners such as Amkor and ASC for assembly and testing. This asset-light approach allows the company to direct most of its resources towards design innovation and ecosystem integration. The strategy is built around three differentiators. One is the AI-centric focus. Unlike larger competitors such as Broadcom and Marvell, which serve many end markets, Astera designs its connectivity products specifically for the requirements of AI and cloud workloads. The second differentiator is the Cosmos software suite. Cosmos unifies all of the Astera's hardware products in a rack. It makes it easier for data center operators to monitor, optimize performance, and manage their connectivity infrastructure. This adds real value for customers because it reduces complexity and provides deep diagnostics. The third differentiator is Astera's support for open standards such as CXL and UA Link. These standards govern the way CPUs, GPUs, memory, and accelerators connect to each other. By supporting openness, Astera reassures hyperscalers that they will not be trapped in a proprietary ecosystem. They can mix and match different vendors' hardware, and Astera's products will still interoperate seamlessly. Through this strategy, Astera secures design wins early in the product cycle, becomes embedded in hyperscaler systems. It then steadily expands the amount of hardware and software content it sells into each AI accelerator rack. Astera Labs has set its sights on aggressive growth. By the end of 2025, all four product families are expected to be shipping in meaningful volumes. The Scorpio X series, which is designed for scale-up GPU interconnect, is projected to become company's largest revenue contributor over the next several years. The company also sees a rapidly expanding total addressable market. Management estimates that scale-up connectivity for AI racks could represent a $5 billion opportunity by 2030. Industry forecasts suggest that global data center capital expenditures could reach $1.2 trillion by 2029, with AI chips dominating that spending. Astera is positioning itself to capture a meaningful slice of this growth. Geographically, the bulk of revenue today comes from Asia, with Singapore, China, and Taiwan accounting for majority of shipments. Sales in the United States remain small but are likely to grow as domestic AI deployments accelerate. Astra's partnerships are another lever for growth. Its collaborations with NVIDIA, AMD, Microsoft, and AI Chip ensure that it will remain a key player in the AI ecosystem for years to come. The company aims to be an anchor partner in what it calls the transition to AI infrastructure 2.0, a shift towards open rack scale platforms that allow greater interoperability and scalability. Competition is fierce in the connectivity space. Broadcom dominates the broader networking market while Marvell technology is strong in Ethernet solutions for cloud data centers. Smaller players like Credo technology also compete in specialized areas. Astera stands apart because of its laser focus on AI specific connectivity and its early leadership in PCIe retimers and CXL memory controllers. The addition of Cosmos software further differentiates its offering by uniting hardware and software into one seamless platform. This makes it more difficult for competitors to displace Astera once its products are designed into hyperscaler infrastructure. Investors, of course, should remain mindful of the risks. Valuation is the most immediate concern. Astera trades at roughly 37 times forward sales and over 110 times earnings. This is far above the averages for the semiconductor sector. Even bulls acknowledge that the stock is priced for perfection. Customer concentration is another risk. In the second quarter, the top three customers accounted for 64% of the total revenue. Losing or delaying orders from one of these customers could have an outsized impact on results. There is also geopolitical exposure. With so much revenue tied to Singapore, China, and Taiwan, the company faces risks from trade disputes and geopolitical tensions. Astera has also disclosed material weaknesses in its financial reporting processes, specifically in risk assessment and segregation of duties. While remediation is underway, these governance issues could be a concern for investors. Finally, the company relies heavily on stock-based compensation to retain talent. In the first half of 2025, stock-based compensation totaled nearly $78 million, which dilutes existing shareholders. All of these risks mean that while the growth story is compelling, the investors should expect significant volatility in the share price. At a stock price of nearly $175, Astera carries a market capitalization of around $29 billion. Its forward price to sales ratio stands at 37 times and its forward price to earnings ratio is about 110 times. These multiples are extremely high by industry standards. However, when adjusted for growth, the picture looks somewhat better. Analysts expect revenue to grow by more than 30% annually through 2026, surpassing $1 billion in sales. The forward peg ratio, which compares valuation to expected earnings growth, is roughly 2.1. That is expensive but not unreasonable for a hyper growth company in the midst of a structural AI boom. Many semiconductor leaders have historically traded at even higher peg ratios during their hyper-growth phases. Supporters argue that Astera will grow into its valuation as revenues scale and margins expand. Critics, however, warn that any stumble in execution could cause the stock to correct sharply given its elevated multiples. Astera Labs has established itself as a critical enabler of AI infrastructure. Its products may not be as high profile as GPUs, but they are indispensable in allowing massive clusters of accelerators to function as one. The company has posted exceptional financial results, achieved profitability, and secured strong partnerships with biggest names in technology. The recent surge in its stock price reflects investor recognition that Astera is not just another chip supplier. It is positioning itself as a platform company shaping the architecture of tomorrow's AI data centers. Nevertheless, the risks are real. The stock is expensive, customer concentration is high, and geopolitical uncertainties linger. Shareholders should be prepared for volatility. Yet, for investors with a long term horizon, Astera Labs offers a unique way to participate in the build out of global AI infrastructure. Thanks for watching. Have a great day.